How did a speculative bubble cause the Great Depression? Have you ever wondered how a surge in stock prices could lead to one of the worst economic downturns in history? The Great Depression is a prime example of how a speculative bubble can wreak havoc. In the late 1920s, the United States was riding high on economic growth. Industries like steel, construction, and automobiles were booming. This prosperity led many Americans to invest heavily in the stock market, often using borrowed money. This practice is known as margin buying, where investors pay only a fraction of a stock's price upfront and borrow the rest. By August 1929, brokers were lending more than two-thirds of the value of stocks purchased. This resulted in over $8.5 billion loaned, which was more than the total currency circulating in the country at that time. With such easy access to credit, stock prices soared, creating a bubble where prices were far removed from the actual earnings and value of companies. The psychology behind this bubble was fascinating. Investors believed that prices would keep rising indefinitely. This mindset led to behaviors like extrapolation, where people assumed trends would continue, and the greater fool theory, where buyers hoped to sell overvalued stocks to someone else at a higher price. This speculative frenzy pushed price-to-earnings ratios to historically high levels, indicating severe overvaluation. However, when confidence started to wane in late 1929, the bubble burst. Stock prices plummeted dramatically over just a few days, beginning with Black Thursday and continuing through Black Monday. This led to a cascade of margin calls that many investors could not meet. By 1932, the market had lost over 85% of its value. This collapse wiped out vast amounts of wealth and caused investors to cut back on spending, which reduced overall demand in the economy. At the same time, the bursting bubble tightened credit conditions. Banks faced significant losses and became less willing to lend money. This created a situation where both consumer spending and investment fell sharply, contributing to a severe economic downturn. Additionally, the bubble's burst coincided with other economic issues, such as overproduction in agriculture and industry. These problems had already depressed prices and profits, leading to widespread business failures and rising unemployment. In essence, the speculative bubble caused the Great Depression by inflating stock prices through excessive borrowing and optimistic speculation. When the bubble burst, it triggered a collapse in wealth and credit availability, severely damaging consumer spending and investment. This sequence of events marked the beginning of one of the most severe economic crises in history. Understanding this episode highlights the risks of financial speculation and its potential impact on the economy.